Have you ever heard the 25x retirement rule? It's a very simple rule that states if you can save 25 times what it costs you to live for an entire year, you can retire yesterday. Today, we're looking at if this still holds true in today's environment. So let's get into the show.
This video is for information and entertainment only. It reflects my personal opinions and is not financial advice. Check the description for more information. Always do your own research.
Hey guys, I'm Alessandro. Welcome back to the show. Today we're taking a slightly different turn. We're not looking at crypto specifically. We're looking at the reasons why we're involved in crypto. For me, the reason I'm involved in crypto is because I believe it's going to allow me to reach financial freedom quicker. That's something I actually believe, and it's something that I am pursuing. What does that mean? That means that I'm going to have more time to play with my son, more time to focus on things that I truly want to focus on, rather than being, a victim to just needing to work to pay the bills. So today we're looking at the 25x rule, which is a very simple rule that states if you can save 25 times your annual expenses, you can retire. And you can retire at a very high probability rate that retirement will see you through in perpetuity forever. Of course, if markets crash and they bleed and they come down forever, this isn't going to work. But based upon historical performance, it has worked with a very, very high percentage chance of working. And what we can see is that obviously, the less it costs you to live, the less you're going to need to retire. Maybe that's obvious. I'm sure it is obvious. But if it costs you 20 grand a year to live, you're only going to need $500,000 to retire on. If it costs you 40 grand a year to live, you're going to need $1 million to retire. Now, it's worth remembering this is liquid, right? This isn't part of your home, for example, because you can't exactly draw on your home every year. This needs to be in a liquid portfolio. And it's based upon a very famous study from Trinity University from a very, very long time, from back in 1998, not very long ago, I guess, back in 1998. And this particular study assessed a bunch of different portfolios. They were 60-40 bonds to stock splits. If you don't know what bonds are fixed income instruments. They are debt to the government. You give the government some money, they promise to pay you back a bit more money. These things are fixed. They're generally very safe. Some governments explode, then it's not safe. But if it's like a US bond, a US treasury, those things have never really blown up in the past and have been very safe investments and have been considered to be very safe for a very long time. Now, this Trinity study from 1998 compared a bunch of stock and bond portfolios and found that there was a very likely safe maximum. If you withdraw 4% from your retirement account every year, your retirement account is very, very likely going to last you for 30 years into retirement. And in a lot of cases, that retirement account is going to grow into your retirement. And when you consider that as people age anyway, they tend to spend less money. That's just like the nature of what happens. And if you even apply like some common sense, my portfolio has gone down 20% this year, I'm not going to pull out 4%. I'm going to be a bit more frugal and try and save a little bit more money, because that happens, 20% drawdowns, they do happen every year. Some years they happen. They can be even more dramatic than that. If you can be a bit more sensible around how much you're pulling out each year, then actually that number, the chance that you're going to be able to retire goes up even further, right? And this is the data. What I've done with this data is I've gone from full history, and I've actually changed it to just being a 100% stock portfolio. I think personally, the 60-40 bond stock split is like a bit outdated, really, and not financial advice. You can do whatever you want. I would never hold a 60-40 personally. For me, I'd never hold a 60-40 bond stock split. I would hold all stocks, or in my case, a lot of crypto. And so this is just on the S&P 500 since inception, since 1871 to today. And I've broken it up into 3 separate categories. First of all is all time. Second of all is after the US came off the gold standard. If you don't know what that was, US dollars used to be redeemable for a certain quantity of real gold. The US dollar became the global reserve currency based upon this deal. People were very willing, or banks, countries were very willing to hold US dollars because they knew they could redeem them for an exact quantity of gold bullions that were backed by those dollars. Very famously, in 1971, Ronald Reagan said the US were coming off the gold standard. Since coming off the gold standard, there's a bunch of awful things that have happened, runaway inflation, and a lot of people, a lot of economists really attribute this back to the US coming off the gold standard, and that's why we have runaway asset prices, runaway inflation, issues with people getting poorer in real terms over time. So that's the first thing that I've extrapolated by. The second bit I've extrapolated by is the intervention, or the inception of QE. Quantitative easing was always like an economist's wildest dreams. It was something that was written about in textbooks and no one ever really thought would happen. Lo and behold, in 2008, when the global financial crisis hit, quantitative easing happened. We started to push money into the economy by the Federal Reserve being the last resort buyer of bonds. They would buy up US Treasury, US government debt, pushing more and more money into the economy. Since the inception of quantitative easing, there is a big change there's been even worse runaway inflation, right? Asset prices go up at a much more aggressive rate. They come down much slower because people know the Fed are going to turn the money printers on and again be that backstop, that buyer of last reserve in case anything goes wrong. And so this is the three areas that I've split it up by. And what this chart shows is this CAGR is the compound annual growth rate. That just means how much has every year this era gone up by in value, compounded from the year before. So it takes into account compounding. Then you've got volatility. This is like how much variance is there. So really, the average growth rate is 6.84% for this era of full history, but that can range from 18.9% less and 18.9% more. A wildly enormous range, right? You can lose 15% some years and you can gain 26%, 25% some years. Now, you can see that since inception, the maximum drawdown was enormous. There was one year the S&P drew down almost 84%. There was another year that it lost 38%. So this is the max drawdown, not the returns for the entire year, but just like top to bottom, the drawdown. In the worst year, it lost 38%. In the worst 5 years, over 60%. And in the worst 10 years, over 50%. These are enormous numbers. But you can see, since the inception of the US coming off the gold standard, nowhere near as bad. Plus, since QE, the worst 1 year is 18% down, but the worst 5 years is 6%, and the worst 10 year is 24% returns. So what does this say? Well, this says, right, back in the day, if you withdrew 3% from your retirement account, you would have always been fine. You would have had enough money to retire on, you could live on it forever. If you withdrew 4% from your retirement account, in this case, you would be able to retire 96% of the time. There will be 4 years out of 100 that would make this plan fail. However, since the gold standard, if you withdrew 4% from your account every year, you would be able to retire in perpetuity with a 94% success rate. Now, this is where it gets really crazy. Since QE began, if you pulled out 5% from your retirement account every single year, that means you only 20x your annual expenses to retire, basically, on this particular, since this particular period of time. You could retire in perpetuity, knowing that your investment is going to grow every year. So you pull out 5%, the average compounding growth rate has been almost 9% in that period. So that's a 4% difference. Inflation has been, between 2 and 3%. So in real terms, you're growing your investment account by about 1% every single year, even if you withdraw a max of 5% every year, which is obviously a lot more than, well, that's 20% more than the sort of like safe kind of like go-to rule that the Trinity study found of 4%. Needless to say, since money has been getting debased further and further, we are seeing that holding assets is the only way to survive that, of course. But not only that, the US stock market has been supported and saved by the government, or by the Federal Reserve, multiple times, right? That is their first port of call. They want to make sure that the stock market is okay. And that has become more and more into fruition over the years. Back in the day, back here, that wasn't something they prioritized. Now, that is something they prioritize. And you can see over time, though, the value of the dollar has gotten absolutely wrecked, right? This only goes up to 2019. But when you consider that actually the value of the dollar is a very good currency. It's been the world reserve currency. This is the Argentine peso against the dollar. The dollar has run against the Argentine peso and has managed to gain, 130,000% against the peso, because the peso has lost so much of its value. Currency debasement is very real. The Zimbabwean dollar lost basically all of its value, complete hyperinflation. $1 US was worth 100 trillion Zimbabwean dollars. Runaway inflation is real. Currency debasement is real. And it's happening in real time, right? The Argentine peso against the dollar has gotten absolutely nowhere. It's got wrecked. The dollar against Bitcoin in that same period has got wrecked as well, right? And so these stats, they don't include any crypto. I wanted to keep this really safe in terms of like the previous examples. And then, the reason I'm in crypto is because I know this is technology that essentially can change the world, right? And I think by being in this space, there's a very good chance I can build a portfolio that allows me to get to this 25x retirement number faster. And not only that, grow at a faster rate. That is what I really wanted to bring you today. I wanted to bring you the 25x rule, where it comes from, and how often it's been correct, right? We can see here that even if you withdrew 5% per year, 68% of the time, you'd have been okay. This isn't a good enough rate for me. I would want this to be more than 90, 95% before I would be willing to sort of like leave a pot and retire on it. And for me anyway, this unlocked like a lot in my brain. This said to me, okay, there is an amount, a very tangible amount that I can absolutely get to that allows me to go and live the life I want to live. It isn't somebody else's random number. You need $1 million, you need $5 million, it isn't somebody else's random number. I know how much it costs me to live a year. I can work that out very, very simply. Once I've got that 25x number, suddenly I've got a tangible figure I can aim towards. And whenever I get there, that's it. Massive lifetime goal achieved. And I can essentially do whatever I want to do with my time at that point. So that is the 25x rule. We're going to be looking at some future videos of how we can build portfolios with crypto that allow us to potentially get to those figures even faster, right? Get to that 25x number faster. And even maybe that number needs to be less. If you look at Bitcoin, for example, if we take the Bitcoin 25x rule, the amount of Bitcoin you need every year has been getting less and less and less and less. In fact, every 4 years, the amount of Bitcoin that you need to retire has been chopped by about 25x, which is enormous, right? Now, of course, I don't personally think the Bitcoin price is going to continue to perform anywhere near as well as it has done in the past. In fact, it can't, right? There's no chance. It'd be worth more than anything in the entire world if it is. Back in 2021, it was 69K. Today, it's 115K. That's good gains. It's not much better than the stock market. I think that's probably going to continue across the same period. Bitcoin's going to keep beating the stock market for the most part, and then probably be somewhere similar to gold eventually in the future. So that covers today's show. If you got some value out of this, let me know by leaving a comment. If you just want to see me cover crypto, again, you can let me know by leaving a comment. There is a video I did here on Syrup, which is institutional backed yield on Bitcoin and Bitcoin backed loans. Go check that out. It's sort of relevant to today because obviously you're able to earn yield. You might be holding in your long-term portfolio. If you want to check out the show I did last week on Base against Solana, go here. Base is looking very strong at the moment. Definitely a worthwhile video to check out. Base have been running super hot recently. Been a bunch of tokens on Base that have been really, really incredible. So yeah, go check that out here. Otherwise, thank you ever so much for watching. I hope you have an excellent day, and I shall see you in the next one.